obviously when you're meeting them, you're asking them certain set of questions.
Right.
Okay. Maybe about their past. Maybe you're also asking them questions which are very broad, nothing to do with to do with business,
Right.
just to make sure that you understand what is their mental model, how are they thinking, how will they react in certain situation.
Right.
So what are those some of those questions which you like to ask? Not a secret sauce, but obviously the general ones.
There is nothing secret out here, right? So one of the things which I think I still believe is that we have got a segregation between a private and a public market.
Right.
But at the end, we are investing in a company, in a business, right? So whatever fundamentals which are relevant for a public company, generally the same fundamentals stay true for a lot of the startups, what we say, coming in the system, right? Probably maybe less than 10% of the startups are disruptive, right? Rest everything is probably basic level of work what goes into these startups, right? So out there, once you're looking for a lot of these, let's say, founders coming in and the qualities, or what you look for in them, or the kind of qualities you look at in the business, that actually maps roughly with how you will evaluate a mid cap or a micro cap in the even the listed space out there.
Right. And one of the things you mentioned was about young founders, right? Well, one is the disruptive founders who are breaking a pattern.
Sure.
And another category which you mentioned was doing an iteration of an existing product or service.
Sure.
Right. Well, in the second one, there might not be some differentiation in the beginning, but differentiation could also come through execution or something else which is not visible in the pitch deck, right? So do you take some bets like that as well?
Now, most of our actual bets, right, recently have gone towards the second kind of founders who have shown execution capabilities, because we might have looked at about 15 odd thousand companies over last about 8 years of existence, right? What we have seen is hardly probably a percentage point of the companies which we met have done something different or something which was like a wow factor, right? Otherwise, everything is like a iteration of something or the other. So a lot of time now we are shifting towards looking at founders who have executed well. And that is actually reflecting in our thesis as well. So most of the time we look at founders who have done at least about 3-4 crores in revenue, because some spaces we can't even evaluate the technology or their delivery, how can they deliver and all that. So once they've got paying customers who validate that the founders have the power of execution, that's the point we tend to get in.
Right. And when you meet these, now that you have so many data points, right, about even investments which have not worked out, do you think these founders had some blind spot, or it's just a matter of timing? Or do you see a pattern even with the young founders? Okay, these are some of the mistakes which are common when you sit down and do your portfolio analysis for last 7-8 years. Are there any emerging themes on that part?
So something like we have stopped believing in something called timing out there, right? The founders who tell us that they were too early for the market. The problem is then you did not do your market research properly, or you weren't able to execute, right? So that was the factor which a founder needs to take into consideration as well, right? Now, in case your internet speed is like very bad, and you're doing a tech business, obviously there are chances of failure out there, which you should have baked in your risk assessment. Now, that can't be the reason for your failure because you already knew the truth. So for us, most of the startups which have failed are mainly because of the execution issues, because ideas, whatever come to us, right? Most of the ideas will work. Even if you want to open up a laminate stand downstairs, right? It will work till the time you execute it well. So unless you're working on something which is path breaking, where you need to do a lot of iterations, a lot of, let's say, R&D, chances of you not being able to find the right molecule or right combination are high. But most of the businesses are running an iteration of something else, and there the execution becomes the key. So the failure is just because you weren't able to execute well.
Right. Now, do you think execution is something you have innate inside you, or this is something you can learn as a founder while you are doing it?
Execution, I think, is a process, right? So when I look at myself, for example, 20 years before, I would have failed in a lot of things. But once you start understanding the patterns and the processes, and you start following the processes to the T, chances are you will be able to execute, right? Now, in case you want to do the sales, like the thing in B2B sales is you need to just continue to follow,
Right.
right? In case you drop your lead after second iteration, then chances of you succeeding are low, right? So there are processes to the sales, and once you look at operations is a lot of it is process driven. So once your processes are set, and when I say set, it's an efficient process to bring the outcome out, chances of success go up heavily.
Right. And I'm sure since you're working with so many founders, right, you know the nuances of founder-investor relationships,
Right.
right? It can be a little difficult at times,
Yeah.
especially when the startup is going through a tough phase, or maybe they are going through a pivot, or switching gears, etc., etc. Right? And since you have been part of the early stage ecosystem for so many years, how have you seen that evolve, the founder-investor relationship?
Right. So I think maybe 8 years back, the relationships were a lot better because startups were less commercialized,
Right.
right? Because what I feel or what founders should look at, you own 80% of the company,
Mm-hmm.
20% is with the investors. So you guys are co-owners of a particular company.
Right.
You want to succeed, investor also wanted to succeed. So there is no misalignment about the whole concept, right? Now there are differences which come in when founders start feeling that okay, there is a founder investor divide. Right now, that is like you guys are on the same side of the table, should be managed a lot better. Now, you need to communicate better in terms of because a founder is someone who is the operating executive, right? So, a
Right.
lot of information, a lot of trust is on the founder. But you do have, let's say, 50 investors on your cap table or 30 investors on your cap table. These guys are there to help you out, but you
Right.
need to really give them information and ask for help at the right time. Now, in case you start doing these two factors, potentially, let's say, out of 50, 30 or 35 investors are not interested because they're just looking for money. But
Right.
15 investors will change your company to a large extent. But that trust and the ease needs to be there from both the sides.
Right. Now, I think because you mentioned 80/20, right? Usually at seed stage or pre-series A, or even before that, let's say at angel stage, usually the dilution is very, very less. So that's different than if, within PE, you may have a controlling stake for a mature company as an investor, etc. Right. So you think the dynamics are different when we're talking about early stage, because founders still feel that we are largely in the controlling position and these guys are enabling us, but still we don't owe them a lot of explanation.
Right. It's not about owing explanation out there, right? It's more about you do have resources, right? You
Right.
do have investors as resources. Investors invested in the money because they believed in you, right? Now, investors bring in money, plus they bring in expertise or connections, right? So that is something which is coming free to you. Now, if you don't know how to leverage that, then you can pick up money from anywhere. But in case you're looking for the good investors to come and work with you, you need to start actually getting them involved into the company.
Right.
Right? Today, in case someone randomly calls me from HL and asks me for suggestions, right? Why would I give suggestions to them, or what do I think about it? But in case I have invested in you and you want me to connect you with someone or give you some kind of suggestions, I would be more open because now I own a piece of the company, which is substantial.
Right. So you're saying that on founder side, there should be some thinking put into when you are inviting an investor to come join you.
Right.
What are they bringing in addition to the capital which they're giving?
Right. This is a fashion I have seen in the industry, that a lot of founders come to us that we are looking for smart money, right? Which means like we are looking for your expertise, we are looking for connections and all that. Once you put in the check, and believe me, 80% of those guys don't even ask you for your expertise or connections, right? Now, that actually spoils the complete name in the market. The thing is, in case you are just looking for money, be upfront, you're just looking for money. But in case you do have expertise available, and if you want to use it, right, then you need to leverage it, harness it. It's not going to come in directly, because I can't just get into your company and start giving you suggestions till the time I feel that you're receptive to it. I can't open up my connections because I've seen multiple founders in my network who are looking for a deep connect into a particular company, not realizing that one of the senior executives from that company is on their cap table. Right. So once you start harnessing, this is like a big problem which I see, that you do have resources, but you're wasting it out. Right. And there the dynamics actually goes for a toss. Now, one of the things which I feel is a big problem is we need to chase the founders for their quarterly reports. Initially it was monthly, then we shifted to quarterly. Now the problem is, in case you don't have your quarterly numbers, how are you running the company even? So those quarterly numbers are not for me. It's for you to actually see. Now, once you start sharing it with me, in case you're doing well, I'll applaud. In case you're not doing well, I'm not going to go and start screaming at you. For me, the problem is that there are certain problems in the company. In case I can help you out with business connections or probably managing the process, I'll help you out because I am a co-owner of the company. Right? So those kind of dynamics needs to be managed a lot well. Right. So I think in my past life, what I have noticed is that this part, value creation mindset, is very much, the framework is already set for the late stage companies, right? Because they look for, let's say, private equity firms who have expertise in a particular sector. They bring in their operating partners, they create value. Sure. Or they will typically make a 100-day plan. So I think on the mature side, it's already in place, right? But in early stage, I think people are still not realizing the potential of angels or HNIs or even syndicates which are investing into them. Right. And I think the reason is that they are even on the investor side, sometimes they are spread so thin, right? So they don't have that portfolio mindset. Okay, we have these 20 bets, and how can we maximize the probability of success for each of these bets? Right. Sure. So either it's too transactional, meaning they are busy with screening or busy with fundraising, but there's very little time which goes on at the portfolio level and engaging with the founders, right? And I think on founder side also, because they are young, that clarity and maturity is probably not there. So that's what I think. I think it's both ways. There is this little completely agree. Yeah. To the founders' credit, I think there are investors who are somewhat on the difficult side. Right. And once you get a couple of those investors on your cap table, chances that you will speak to other investors will also go down, because then you start feeling that most of the investors are intrusive. Right. And recently we have been traveling to cities outside tier 1, right? So for example, we went to Lucknow, and then we are going to Bhopal. Before that, we did one event in Jaipur, right? I'm sure you have traveled to tier 2 cities and you have lived in tier 2 cities basis our conversations. Do you think the ecosystem, the startup ecosystem, is different in those cities versus tier 1 cities? Yeah, it's a lot more different, right? So when we talk about at the high level, right, there is a Silicon Valley and there is a non-Silicon Valley, right? The difference is that in a particular hub, everything is so accessible, so close to each other, like in Silicon Valley, right? So the chances of growth, chances of success increase tremendously because all the infrastructure is at one place. So once you go to tier 2, tier 3 towns, the problem is the ecosystem is not so evolved. Right. So out there, you do have a lot of opportunities lying there because the spending power of most of those guys is as good as tier 1 cities. But then the way people actually act in those pockets could be a lot different than other pockets. So in some cases, you find that the founders in those cities living with their parents, having a steady income coming from some business. So they don't have that much hunger into the system, right? So they will start something, but they may not be so serious because everything is sorted for them in life in terms of, in case they're earning 30,000-40,000, they're fine. But then a lot of guys you will see that who come out of from that system and they see their father running a successful business. Now those things get into their genes, which means they could be a lot more successful in other businesses because they have seen how the process works for over, let's say, last about 8-10 years. So there the chances of success for such founders tend to even grow. But then because the ecosystem thought process is a lot more different, there people think a lot about business, while in the hubs, people talk a lot about startups. So
Right.
marrying those two becomes a lot difficult in terms of mindset.
Right.